Hello, everybody. Welcome back to the show. I almost missed the show. I'm just sitting here looking at the chat. I typed in a response to Dan about an HSA question. I looked over. It was 7 o'clock, 7:01. I was this close to being late. It's not good. Hope everyone's doing well. Yeah, I'm kind of fired up. It's been very hectic, my life. Yeah, that's okay. It's all good. Just extremely busy. Busier than it should be. All right. So, I already got a thumbs up. Well, that's good. Thanks, Steve. And my chat over here is working. Look, I can show you Steve's thumbs up. There it is. So that's working. That's good. So I'll get right into the little topic to start with, and then we'll get to your questions. And the topic, how can you figure out if you want to retire, you're worried about the stock market? What if I retire and the next day everything just falls apart? How resilient is your retirement plan? And this topic, I'm actually want to do some more videos on this, but it came up from an email from a viewer named Joe. Great, he has some great questions. I'm just going to focus on one, and I'm not going to show it to you. I don't want to show you his email address, but I'm going to show you a few things on the screen in a minute. But he said, "Hey, you've shown in the past. Actually, this I will show you." He said you've shown in the past how with Boldin you'll come into an account and you'll show how we can maybe reduce the assumed rate of return for, say, the first decade. You can do that here, model a future. You can like put a low rate here, let's say 4% for a stock portfolio or something. And then, 5 years later, 10 years later, go back to whatever you think sort of the long-term average is. That was, he referenced that. And then he had two questions about it. He said, well, one, aren't you kind of double dinging yourself because, if you're going to run a Monte Carlo simulation, doesn't it already include a bad sequence of returns? That was his first question. And his second question was, how realistic is it? Yeah, you've lowered the assumed rate of return, in this case to 4%, but in tools like Boldin, that's also going to lower your standard deviation, the volatility, how much the account swings from year to year. And so, does that kind of blunt the effects of this really bad sequence of returns risk? And I think those are both excellent questions, and they underscore sort of a bigger issue, in my view, and that is that no matter how you test a portfolio or a retirement plan, whether you use historical data, I'll show you that in just a second, you use Monte Carlo simulation, the assumptions you make, there is no perfect every strategy has problems, which is probably why, if you're concerned, it makes sense to sort of stress test it in a lot of different ways. I certainly would not, and I agree with Joe, I wouldn't rely on the strategy of lowering the assumed rate of return for, say, the first decade as the only way to stress test your retirement plan. I still think it has some value, but I agree with Joe. It has some downsides too. In terms of sort of double dinging, that was his term, because, doesn't Monte Carlo already, it simulates all these different, say 1,500 or 1,000 different what ifs. What if it does this, this, and this in terms of the stock market and inflation? Aren't you kind of, piling on? And I think the answer is yes, but you're kind of piling on with a purpose, right? You're saying, yeah, let's zero in on that first 10 years, let's just say, in a 30-year retirement. Doesn't have to be 10 years, and let's pretend that's really bad. And so, yeah, it is sort of piling on, but I think that's kind of the point. Is it the best way to pile on? Maybe not. I'll show you an alternative in a second. Because when I tested this plan, I did this tonight, I tested the baseline plan, which has a 91% chance of success. I then went in and created a new scenario that I cleverly called bad SORR, for sequence of returns risk. And I dropped from roughly 8% to down to 4% for 10 years. It actually only dropped the chance of success by 4%, which kind of surprised me. And it could be in part because of the lower standard deviation. We can actually look at that, by the way. I can show you what I did. So I started with 4%, and because that's a relatively low rate of return, the standard deviation's only about 7.5. So what that means, by the way, and I'm no statistics expert, Although I have taken 2 statistics courses, one in undergrad, one in law school. I got A's in both. No, that's not true. I got a B in college. Anyway, the idea is one standard deviation away from the mean. This is the mean. So one standard deviation, which would basically comprise 2/3 of, if you imagine 100 years, this would happen in 2/3 of that, 66, 67 years. The rate of return will fall somewhere between 4% plus 768 at the high end and 4% minus 768 at the low end. And so when you put these numbers in a Monte Carlo simulation, you're saying, hey, 2/3 of the time, you should be one standard deviation away from 4. And that's still a pretty big range, right? I mean, that's 11, 12% at the top end and a negative number, -3 or whatever at the bottom. And then you can go 2 standard deviations where you double this and add it to 4 and double it and subtract it from 4. And you can even go 3 standard deviations. I don't know. Does it make sense to go beyond that? I don't think so. I think at 3, aren't you like 99% of all events, I think, in any event. So that was the idea. And I was surprised that it didn't make that much of a difference. But again, I'll come back to Boldin. Who knows? I could change any number of things about this made up plan. This is a demo account. And who knows what would change it. But I did notice if you go back to the baseline, just going to pessimistic drops it a lot more. Now that's a 20% decline in the assumed rate of return, and it's throughout the entire plan, not the first 10 years. So, maybe in some ways this is a better approach. But I do like an approach. This is something that Boldin can't do. If I could change one thing about Boldin, it would be that it could do historical analysis. In other words, run a simulation based on historical data. At the moment, it doesn't do that. Both Prelana, which is right here, it's a demo account, and Projection Lab do. I'm going to show you Projection Lab. I like the way they've set it up, but I want to point out one thing about Prelana. And Prelana takes a long time to learn. There's a lot going on in this software. It can do a lot more, maybe not a lot more, but it can do more than Projection Lab or Boldin. But along with that comes a lot of complexity. In any event, you see this here. Use correlated returns, right? What's that mean? And ROR is like rate of return. But you might have 6, 8, 10 different accounts, right? A couple IRAs. If you're married, you got taxable accounts. You have HSAs, traditional Roth. And so the idea here is when we run the simulation, do we want the accounts to sort of move in lockstep? Not literally. You might have different rates of return for each account, depending on what you have invested in it. But if it's a good year, it'll be a good year for all the accounts. And if it's a bad year, it'll be a bad year for all of the accounts, right? And so if you check this, it uses a correlated return across all your accounts. And that's what Boldin does now. So with Prelana, you get a choice. I can uncheck that if I want. I can say, no, don't correlate all the accounts. Don't use correlated rate of returns. And with Boldin, you don't have that choice. They don't give you that option. They're going to correlate all of the accounts. And you say, okay, there are 2 questions, right? These 2 questions come to my mind. One is, well, which one's right? Don't give us a choice. Let's just pick the right one. And then the second question is, does it make a big deal? I'll show you the answer to that question here in just a second. But the problem is there is no right answer. Probably in most cases, both are wrong, right? Assuming that all accounts are correlated is probably wrong. And assuming that there's no correlation among them is probably wrong, depending on how you've invested in each of your accounts. I suppose if you've got the exact same asset allocation, which some people might, across all of your accounts, then using a correlated rate of return makes sense. But if you don't, then it's probably not a perfect solution because you're not going to have perfect correlation between all of the accounts. But they're not going to be totally uncorrelated in most cases. I suppose unless you had some weird portfolio, you had Bitcoin in one account, and I don't know is anything correlated. I guess the S&P 500 has actually been kind of correlated with Bitcoin. I don't know. The point being, and this is something Stuart at Prelana I think points out, or his team in the manual. I'll go back to it. they kind of point out, look, trying to come up with something other than these two extremes is really, really complicated. So he gives you the choice. So if we use a correlated, you're going to get a lower chance of success rate, all right? Because by unchecking this, so when we checked it, I got 90%. If we uncheck it, well, now he's going to run through the simulation based on each account independently of the others. So, one account could have a good year next year, and a different account could have a bad year that same year. And that kind of diversification actually increases your compound annual growth rate. I know you're thinking, Rob, it's Monday night. Please just speed this up for the love of God. All right, fine. If we run this, watch, it won't be higher than 90%. It better be higher than 90%. I'm going to guess 96, 97. I've run it a couple of times. Takes a while. Yeah, 96. And so one of the things that Boldin had said when was they were trying to be a bit conservative, and that's true, they were, by moving to correlated. Which one's right? Neither one of them are really right. Now, I want to go to Projection Lab just for a second. So with Projection Lab, again, like Prelana, you can use historical data, or you can use a Monte Carlo simulation. This is based on a historical data. Now, even historical data is not perfect, because in this case, the stocks are based on the S&P 500. And if you're like me, you've got other stocks. You don't just have S&P 500, and so it's not perfect. But if I could only evaluate my portfolio, my retirement plan one way to assess, how will I survive if it's a really bad decade, it would be something like this. Historical analysis. By the way, we've looked at FI Calc. That does it too. So you could use that, right? I see. I've still got, there we go. I've still got his thumbs up in there. Boy, it's one of those nights. The reason I like this, well, first of all, studies show that historical simulations are actually quite good. If you're like me, you always think, but what if the future is a lot worse than we've ever imagined? And that's a fair point. It doesn't mean that historical simulations are perfect, but when they've sort of back tested them, say, well, how did it turn out? Historical simulations actually fare pretty well. But the thing I like about this is you can dive in and look at really bad historical time periods. So you notice this plan's got an 88% chance of success. One of the nice things that Projection Lab does is it gives you all the years. And like, for example, and I know this is going to be hard to read, but this is 1928. And it actually failed in the middle of the plan. We can look at it. It ran out of money. Of course, we all know. In that case, what was the problem? Stock market crash, right? 29, 30, 31, really bad years. But there was no inflation. In fact, in the early part of the Depression, there was a deflation. So this wasn't an issue like we had in the 70s with runaway inflation, but this was just a really bad stock market. And it tanked retirements that started in 1928, again, assuming all of the data I've got in this particular plan. But we can also look at other things. We can say, well, how would my plan have fared if we lived through the 70s and early 80s again, which would be plans in this range that started in the mid to late 1960s, early 1970s. And you can see almost made it, failed in the middle, almost made it, barely made it. And this is really important analysis that I think Projection Lab does really well, because it's not just enough to say, well, it failed. Because, if you're planning a 30-year retirement, there's a big difference between one plan that fails after 15 years and another plan that fails after 29, right? And so it gives you all that data, and you can click on any of these and get the information. And so I think this is just a great way to stress test a portfolio. And the other thing I'll show you, and then I'll get to your questions. The first decade of this century was not great, right? We had the tech bubble burst, and then we had the financial crisis. And you see that show up in this data. So here, for example, is a retirement that starts in 1997. The data right now only goes through 23. So I guess he doesn't have 24 data in here, which kind of surprises me. But and then it loops back to 1928 because it needs more data. So it's looping back into a really bad time period. You can change that, by the way. You don't have to loop back to 1928. But the point is, these periods that that started in the right around late 90s, 2000, they struggle because, and we know, because the stock market was really bad. In fact, we can open one of these up and you can see, the portfolio just took a nosedive the first 3 years because of the tech bubble bursting. And then, it got bad again. So all of that, I know I kind of gone through a lot kind of quickly. I think going back to Joe's email, I think you raises some excellent points. Lowering an assumed rate of return in the first decade in any retirement planning software, I think is worth trying, but it's by no means some complete solution. And as we saw with Prelana, just changing whether we're going to treat all the accounts in lockstep, so to speak, or not, can make a pretty big difference. Not huge, but it was a 6% swing. To me, the best way is historical simulations. Right now, you can't do that in Boldin. You can in Prelana, in Prelana, and you can in Projection Lab. And as I showed you, I really like Projection Lab's interface and the data it gives you. I think it's excellent. Okay, that's it. By the way, if you want to try out well, they all offer free trials, so you can try them out for free. I can get you a 10% discount code for Projection Lab, but you have to sign up to my newsletter. That's actually at the request of Projection Lab, by the way. But I've set up a new welcome email series. So if you sign up for the newsletter, you'll get 5 emails over 5 days, and then you just get the Sunday newsletter. But in the first one, you'll see the code for Projection Lab. And then, you can unsubscribe if you want. Won't hurt my feelings. Okay, maybe it'll hurt my feelings a little bit, but that's okay. All right. Now to your questions. Is anyone still watching? It's like, Rob, I don't know. You're drinking coffee awfully late. Maybe that was a bad choice. Maybe. All right. I'm going to go to the top. I'll show you. I can't show you the first few questions, but then I will be able to shortly. So question, let's see. If you saved $100,000 in an HSA, HSA is a health savings account that you can contribute to if you have a qualifying high deductible health plan. So if you got 100 grand in there, could an HSA and long-term care insurance be interchangeable? Would they basically cover all the same items? So you certainly can use an HSA to fund, qualifying medical expenses, including long-term care. I think there could be possibly in theory, some long-term care expenses that might not be HSA eligible. There's something in the back of my mind that says that's possible. So you'd want to double check that. But generally, medical expenses, that's the point of the HSA. And so, I wouldn't necessarily in my mind, I don't think of them as interchangeable. I certainly think you could choose to self-insure. In other words, not buy long-term care insurance, which is what we've done. And that's true whether you have 100 grand in an HSA or zero. The HSA gives you tax benefits, obviously very important. But the real question just is, how are you going to fund long-term care needs? And of course, some will end up relying on Medicaid, right? And others will maybe rely on the equity they've built up in their home or savings. Obviously, if you have it in an HSA, then every dollar, again, assuming all the expenses are eligible healthcare expenses, no taxes are coming out of it. So every dollar can go for the care that you or loved one would need. So yeah, and that's kind of our plan. I'll probably start spending some HSA money when we hit Medicare age. I think that's my current thinking, but I'm years away from that. I mean, I can't even see that. It's so far away. Okay. Aaron asked a related question. Can you do a rollover from one HSA account to another more than once a year? So the short answer is I don't know. With an IRA, so there's a rollover and there's a direct transfer. This is my understanding, but folks in the chat will correct me if I'm wrong. With an IRA, they've got that limit on how many rollovers you can do a year, and that's one. The idea was this: you can hold on to the money for a little bit and then send it on to whoever you're moving your IRA. But the IRS, said, well, wait a minute, people will just keep doing that all through the year so they can have access to the money. And that's a problem. So we're going to limit it to one. But a direct transfer where you never touch the money, and sometimes you might get a check, but it'll be made out to, in this case, Aaron mentioned Fidelity. So it'll be, for the benefit of you, but made out to Fidelity. And I've done it that way before, where I actually took a photo of the check and deposited it that way into the IRA that I was transferring it to. But I never had control of the money. I don't know if that same rule applies to an HSA. I've never heard of it applying to an HSA. I could Google it maybe, but I won't do that. Maybe someone in the chat knows. I've just never encountered that question with an HSA, and I always prefer a direct transfer. I don't want to touch the money. That's just trouble. All right. Kat mentions the subreddit. Let me show you this. So I started this a week ago. And I just called it Do-It-Yourself DIY Retirement because, I don't know why I called it that. I guess that's what we're all about. Look at this. It's already got 1,500 members after a week. It's had 34,000 visits and a lot of great comments and discussion. I hope you can join. Yeah, it's been a lot of fun. All right. Okay. Now I can show you the questions. PH wants to know what does a bond fund like FXNAX play in a diversified retirement plan? Well, I don't know. FXNAX. Fidelity Bond Fund. I'll show it to you in a second. This is just a U.S. bond index fund. This might just track the Bloomberg. I don't know. Here it is. Let's just see if we can find Bloomberg in here. There it is. Yeah. So this Bloomberg U.S. Aggregate Bond Index is the same index that B&D tracks, I'm pretty sure. And so, let me pull the comment off. So this is, we talk about this kind of fund all the time. It's going to invest in U.S. Treasuries, some high-grade investment-grade corporate bonds. I think it's got some asset-backed, like mortgage-backed securities, bonds. It's got a duration of around 7 years, I would say. Let's see if we can just find duration. Oh, they mentioned duration a lot, but do they tell us what it is? Here we go. Oh, only 6 years. Okay. That's interesting. That gives you an idea of how much this fund will change in value if interest rates go up or down by 1%, as a rough rule of thumb. So if rates drop by 1%, this fund would go up in value 5.9. If rates rose, it would go down 5.9. But keep in mind that that's just one aspect of a bond fund. As rates go up and this bond fund starts to buy new bonds, it's going to get a higher yield, right? The yield on this fund today is a lot higher than it was a few years ago. And yeah, I think this is a part of my portfolio. It's not the only way, of course, to get fixed income exposure. It's this type of fund is sort of the standard fund in a Boglehead 3-fund portfolio. The one thing these don't have, because the Bloomberg index that it tracks that doesn't include them, is tips. So if you want tips, you'd have to have another fund. All right. All right. I don't normally get into politics. This is kind of on the, I won't do. Okay. I'll just say this. This whole thing about the team name of the Commanders, I don't get why. I don't get it. I've gotten used to the Commanders. Actually, my wife, who's not particularly a football fan, thought they should just stick with what was it called? The Washington team? Something like that. Yeah, I like it. Okay. Just don't change the name of the Ohio State Buckeyes. That is where I draw the line. Okay. Bill says, last summer, all we talked about was how the S&P 500 was overpriced and the market was due for a multi-year malaise. Still true? Well, I think it's still true that it's overpriced, at least as compared to history. I think all of the models that forecast future returns would say the next 10 years will not be great. So that's still true. We can look at the Shiller PE. Now, what the next 10 years will actually look like, that's a whole other story. Yeah, we're still pretty high, 38.45. So, yeah, it's still richly valued, no question about it. The bigger question in my mind is, what, if anything, do you do about it? Do you change anything in your portfolio? I haven't changed anything. So Rich says, retired and have excess cash I want to invest without risk, considering interest rates will be dropping sooner rather than later. Well, maybe not. Is it better to do a 5-year TIPS bond or CD ladder? A 5-year TIPS or a 5-year bond or a 5-year CD ladder? I think that's the question. Well, first of all, the assumption that interest rates will be dropping, I don't agree or disagree with that. I don't have an opinion. I can imagine a world where interest rates go down. I can imagine a world where interest rates go up. I can imagine a world where they more or less stay the same. And so in the way I would think about this, Rich, is the first question is, what's the purpose of the money? You don't want to take risk. So all of those are, that you've outlined are risk, assuming the CDs are in FDIC insured accounts, assuming the bonds are treasuries, obviously the TIPS are issued by the US government. I mean, it's about as risk-free as we can get in this life. And so it certainly meets that. But what is the goal for the money? For example, why a ladder? Or maybe the CD ladder is different. Maybe it's just 5-year TIPS or a CD ladder. I don't know. I would think about what I want for this money and what the purpose is. If it's just, I'm not sure what I'm going to do with it, but I want to keep it safe, I don't have a plan to spend it, then I think some combination of TIPS and bonds would be fine. Keep in mind with TIPS, you accept a lower starting yield in exchange for increases in the face amount of the TIPS as inflation goes up. And whether over any period of time that turns out to have been a better deal than the higher yielding treasuries depends entirely on what inflation turns out to be. It's one of the reasons I tend to split my bond portfolio between the two of them, because I don't really know how inflation is going to turn out. And every time I think I do, I'm wrong. I get surprised. So, but there are other ways. I mean, those are three, I think, reasonable approaches. You could just get a T-bill ETF. One question: if you thought interest rates were going to drop, I would assume you want to lock in current yields on a 5-year. If you're assuming a 5-year time period, on 5-year bonds or TIPS or 5-year CD. If you think rates are going to drop, right? But personally, I would not make an investment decision based on an assumption of what interest rates are going to do. Just my experience has told me I'm not good at that. Maybe others are, but whoops. I'll come back to that. John just did a backdoor Roth. Thanks for your video on the topic. Congratulations. It's kind of scary. At least it was for me. It's like, am I doing something wrong? It seems too easy. All right, back to Keith. Nope. Here we go. Thoughts on a 50-50 with DFUS, VNQ, and an HSA. Okay. Well, let's take a look at those two funds. So that's dimensional funds. I assume it's a US-based, US equity market. So I'll show you that fund in a second. Let me pull up VNQ, which is real estate. So this is the real estate. I've owned this in the past. I don't own it now, just because I don't have a separate allocation to real estate. By the way, I think it's a a really reasonable approach to have a little extra allocation to a REIT beyond, let's say, what total U.S. market fund would give you. I did that for many years. I was just trying to simplify our portfolio. But this is the ETF version. They also have a mutual fund version. And then DFUS, let's see, I'm an individual investor. This is their fund. So this is an ETF, so you could buy this. Their mutual funds, I'm pretty sure you still have to buy through an advisor, but I could be wrong about that. But I've not studied this fund. I'm aware of it. I've not looked at its history. It looks like its benchmark is a Russell 3000, but I don't believe this is considered an index fund. I don't think. Well, maybe it is, or they have some sort of automated system. But in any event, I suspect this is a reasonable fund. To me, the bigger question, Keith, is, and the way I think about it is, what role does the HSA play in my overall allocation? You know, for an HSA, you're going to have 50% U.S. stock exposure in some form, a DFUS, okay, and 50% in real estate. Those are both asset classes that I would feel very comfortable including in an HSA because they, you know, their expected returns are generally good, right? So, you know, in terms of like which fund to put them in or which account type, I think they certainly would go well in a Roth or in this case an HSA. The bigger question for me would be, how does that affect your overall asset allocation? That's what I'd be thinking about. I can't answer, you know, that would be for you to evaluate. But these are certainly, these asset classes, I think, are perfectly reasonable in either a Roth or an HSA. Bill, T-minus 41 days to retirement. Excellent. I want to ask a question, by the way, that triggered a thought. Let me set this up. Here we go. What is your investing experience level? And I'll put in here, never invested. It's okay. That's you. No worries. I'll say beginner. I'll say intermediate. I mean, you interpret these however you want, and I'll say, I won't say expert. That's wrong. I'll just say lots of experience. I prefer that. I'd be curious. I think I misspelled experience. That's all right. All right. This comment, Bill, 41 days to retirement, it reminds me, so when I went to law school in Boston, my wife and I, we'd only been married a year. We lived on Beacon Street, right outside of Kenmore Square. The marathon would run by our apartment every year. We were on the 5th floor of a walk-up, so there's no elevator, no air conditioning, no washer and dryer in the building. And by the 3rd year of law school, we were kind of ready to get out of Boston. And so we had this little chain with the little beads, you know, and we'd counted them out to how many days we had left until we could leave Boston. By the way, Boston's a lovely town, but our experience there as poor law school students, living in that apartment, it was tough. And we'd clip one off every day. We got exciting to see this chain get shorter and shorter. 41 days. You can probably taste it from there. I mean, that's so close. All right. Let's see. I feel like I'm slow at getting to the next question. There's a lot of downtime. I gotta do better. I think I could just start the live show and just let you guys chat amongst yourselves and then just shut it down in an hour. Well, So Vinyl, aka Jonathan, says if you have a dividend growth portfolio and the dividends still come in, you can just live on those. Well, maybe you can, maybe you can't. I guess it depends on how much you have, what the dividends are, and what your expenses are, right? I mean, if you have even if it's somewhat tilted towards dividends, but not in any extreme crazy way, you're not like doing covered call ETF nonsense, but you tilt more towards dividend payers. So instead of a 1.5% yield, you're getting a 2.5% yield, or maybe 3. Now you could have other higher yielding things. Maybe you have some REITs. Maybe you have some bond funds potentially. If you can live off of the dividends, your chance of success is huge. I mean, but the reason is, it's not because, and this is my opinion, and you guys can all disagree with me. That's okay. It's not because there's any magic to the dividends. It's just that you're not spending very much of your portfolio. When you open up your statement and it says you've got X dollars in there, it doesn't care how much of that came from dividends. It's just a dollar number. Some of it came from dividends. Some of it came from growth. Some of it came from your initial investment. You're going to pull some amount out. If you limit yourself to the dividends, I mean, yeah, psychologically, I get it. It almost feels like interest on a savings account. I'm going to leave my $1,000 invested and just spend the interest. I'll always have my $1,000. And dividends feel the same way. That's not quite really how they work, but I get the psychological boost one gets from just spending dividends. And by the way, if that funds your retirement, I think that's great. That's exactly what I would do. If I could live off my dividends, that's exactly why wouldn't I do that? But I think in terms of an approach to retirement planning, you're probably underspending, which may be fine. If you're happy, the whole die with zero, it's not my thing. I get that there's some benefit of thinking about that concept, but I don't think one needs to spend every dollar they have to have a rewarding retirement. So in any event, I don't know. I love my dividends. People email me, Rob, I know you hate dividends. I don't hate dividends. I don't. It's just that they're not magical. Yeah. Kyle says, did I call it a clown show? Maybe I did. You called the current admin a clown show a few months ago on a live show with regard to tariffs. Is the stock market hitting all-time highs today despite the tariffs talk now? Yeah, I generally, what the stock market has done the last few months, I just don't find it all that significant. It's done well, and that's good. It's going to do poorly. I don't know when, by the way, and it might not be during this administration. It may be because of the administration or not. It could be for 1,000 different reasons, and who knows when. I do think that at least so far, it doesn't appear as if tariffs have caused significant problems to the economy, right? Will that change? I don't know. I guess we'll find out. It is sometimes hard to avoid politics when it affects our retirement. Lee says that Mark Zorel and Plan Vision use eMoney. How does it compare to Boldin Projection Lab? So there's that's a great question. So eMoney is a tool that's used by advisors, right? They don't market their tool to regular folk like you and me. Same with Right Capital, same with Money Guide Pro, same with Income Lab, although I pay for Income Lab. I've canceled it because it was like $160 a month. Two things about all of those programs, but I'll focus on eMoney. When you get access to one of these programs through an advisor, you do not have the same level of control that you do when you use Projection Lab or Boldin or Prelana. There are settings that only the advisor can set. and things that only the advisor can do. And that's on purpose, right? Because remember, this is an advisor tool. And think about it from an advisor perspective. You've got 100 clients. You've set up all these plans. If they had total control to do whatever they wanted, some number of them would go in and mess things up and then call you and say, I messed up my plan. Can you go in and fix it? So advisors have the ability to lock things down so you can't break them and so that I can't break them. So in that sense, Boldin, Projection Lab, Prelana, I much prefer, because I have complete control over every, with whatever features those tools offer, I can change anything. I'm not locked out of anything. And with eMoney and the others, you will be. So some people have emailed me and said, I got free access to Right Capital, which I did too, through some advisor that was doing it. I think some of these companies have caught on to that and they're kind of shutting that down. Because you could think about it, the fee structure for these programs is not very expensive, actually. Like I could get access to Right Money, and then I could sell you guys a license. I could say, okay, if you want to use Right Money, pay me $10 a month or whatever, and I'll be the advisor, and I'll give you access to it. And these companies are like, yeah, that's not going to work for us. But even if I tried to do that, like as an example, with Income Lab, you the user, the client, right, can connect your accounts, your investment accounts, but you can't add them to your plan. I, the advisor, would have to do that. Well, okay. I mean, again, if I were a real advisor, then and I had real clients, that might make sense. But what a pain if you try to use the tool on your own. It's just not workable. The other thing I'll say, though, is that, and this is certainly true with Boldin, Projection Lab still has a little ways to go on the retirement planning side, although I love what Kyle is doing there. But these tools are, I think, as good as these professional tools. Probably none of them give you the level of granularity that Prelana does. But even a Boldin, to a lesser extent, Projection Lab, it doesn't have some tools yet, like Social Security optimization, Roth optimization, but it does a lot of other things extremely well, like the Monte Carlo and historical simulations I was showing you. And I think just its general user interface is fabulous. These are on par with these other tools. There are things that other tools do that I really like. eMoney would not be one of them. It's a little bit stuffy. It's almost like it needs an update. Income Lab, I like some things that it does, but the tools that are coming out for you and I, they're competitive with the professional tools, in my view. Okay. This is a great question from HS. Any advice for getting over the psychological hurdle of spending money in retirement? Would you say you have reached a level of ease and comfort around money and spending now? I have, although my situation is really not a fair comparison, because so when I first retired, so I retired from the practice of law in 2016. I sold my business in 2018, and at that point I thought I was done. And I was scared to spend. First of all, I retired early. I mean, I was 49 when I guess retired from law. So I was 51. I don't remember how old I can't remember how old I am, but I was young for retiring. And yeah, I was nervous about spending money. And I was surprised at how nervous I was. And what I found was you just, you give it a little bit of time and it gets better. Now, then I ended up going back to work at Forbes, and then I started this YouTube channel and my website. And so my business has been able to make enough money that we can live off of. And so I kind of I'm not back to the point of spending down my retirement. So that's just a little history. But when I was in that mode, because even when I started at Forbes, I wasn't making much money at first. It was more just, I thought it'd be a fun thing to do. And they did provide health insurance. So that's a bonus. It took me a while, but part of it's just time. Give it time. The other thing I would say is if you can think about your expenses in terms of what you need to survive and everything else. So, doomsday, the wheels come off, the market crashes, inflation, if you had to cut your spending to the bone, what would it be? And how could you handle that level of spending? And maybe you say, well, I've got Social Security and pension. If I had to, wouldn't be fun, but if I had to, I could live off of it, or I could live off that plus a little bit of my savings. That always made me feel better, trying to imagine a worst case scenario. I mean, things can always get worse than we can imagine, but you know what I mean. And I think sort of embracing that and thinking, what would I do? What changes would I make? Maybe I'd move, sell a car. I don't know. But would I be okay? And if the answer is yeah, I'd be okay. Now, if the answer is no, I wouldn't be okay, then, it depends, why. And, there's other things there. But that kind of helped me too, oddly enough. Imagining the worst or a really bad scenario helped me get comfortable. So I don't know if that's good advice, but it helped me. This is an odd question from Keith. My recollection is Keith has asked me other interesting questions in the past. The short answer is I don't want a pet. Okay, next. I've had them. Their work. So Jamie wants to know my thoughts on Empower versus Boldin. I think for a free retirement planning tool, Empower is a good tool, and it gives you the ability to customize some things. You can compare scenarios. It's really, though, a totally different kind of retirement planner than Boldin. Boldin, you can run Roth conversion analysis and Social Security claiming analysis, and you can actually input a detailed plan. Now, not everyone needs that. You may look at your plan through a tool like Empower and say, you know what, I'm fine. Yes, I could refine it. I could streamline it. I could analyze it 24 different ways with Boldin or Prelana or Projection Lab or whatever. I just don't really need to do that. I mean, I look at the numbers, I'm good. Or I'm still 20 years away from retirement. So Empower is good enough for now. And I think that's reasonable. In terms of getting two varying scores, I would try to figure out why that is. It depends. Also depends on what the variance is. If one's 94 and the other one's 89, I probably wouldn't read a whole lot into that kind of difference. If one's 94 and the other one's 74, I would probably at least try to understand why. Yeah. I mean, they both do, Empower does a Monte Carlo simulation. So it uses asset returns. It comes up with the values itself. I don't believe you can change the assumptions on the rate of return like you can in Boldin. So that might be my starting point. What's my assumption for my rates of return in Boldin versus what Empower might be using? And they have a document. There's a link to it in the retirement planning tool itself that explains everything that they've done in that tool. It's quite detailed. It's pretty good. I'll have to look into this. The 720p stream is killing me. I don't want anyone to die. I don't know how to change that. It is 720. You're right. I'll work on that next time. That's not good. Cat. Well, we did. It was kind of through the whole Monte Carlo analysis and stress testing a portfolio a plan so that you can see how your plan would handle a stock market crash, right? And that's where, and I don't know if you were watching then, but we went through Projection Lab, which is right here, as just one example of a historical analysis where you could look at your plan through historical time periods and see, for example, again, one of the ones that is maybe pretty good is around 2000, how your plan survives because we had 2000, 2001, 2002 were big drops, and then there was 30+% drop in 2008. So that'd be one place. 73, 74, those were really bad years. So you could look there. If you were concerned about inflation, then you could look at plans that started in the mid to late 60s that got got hit by inflation in the 70s and early 80s. You could go back to the late 20s. This starts in, I guess, 28, but you can go back further than that. Not with this tool, but where you lived through the stock market crash of 29 and 30 and 31, and there were some others later in the decade. So it's sort of just a way to get an idea of how your portfolio and your retirement plan would handle a stock market crash. It's not the only way. Again, just a regular Monte Carlo simulation, and you could look at the worst results, the worst outcomes. Well, I can show you that too. Let's see. So if we go back to Boldin as an example, I can run a Monte Carlo analysis. I'm going to vary the investing returns. I would vary inflation as well. You could vary the other things and run it. And it gives you an idea. So this plan's actually pretty good, right? It's got 92% chance of success. And so even in some really bad years, you do just fine. But obviously you could run this for your own plan. And again, you can do this in Projection Lab. You can do this in Prelana. And just look at the bad outcomes, right? If the good outcomes we hope for, but that's not what we're planning for, right? That's not what keeps us up at night, I don't think. Dave says I need glasses to see Medicare coming. I have uncorrected 20/20 vision. It's true. I read a story about someone who has, is it 10/20? It's like twice as good. I think that would give me a headache. I don't know how that would work. Is that Superman? I don't know. So Josh wants to know when Bill Bernstein is coming on the show. I need to email him because he said he could come on after June. Let's see. We last emailed on 1/9. I want to get Andy Penko back on the show too. He's agreed to do it. I just have to reach out to him and figure out when. Let's see. I'm going to email Bill right now. Well, I got to put dates in there. I'll email him after the show because I got to look up the dates. All right. Mac wants to know, is it efficient to just have a balanced fund which represents your asset allocation and let the fund manager do the rebalancing? What are the disadvantages? I think it's a great way to go. It's particularly in a retirement account, right? The problem with that approach in a taxable account is that you'll have a lot of bonds, depending on your asset allocation, and that's going to generate some taxable income each year. So you got to be mindful of that. I'm not a fan of balanced funds in a taxable account, but I use one. My wife and I both do in a retirement account. In fact, we have almost 100%, not quite, but almost 100% of our traditional retirement accounts in a Vanguard target date retirement fund. And I think it's great. Now, one potential issue that I see people raise with that is they'll say, well, what if the stock market's down? I don't want to sell my stocks. I want to just spend my cash in bonds. But if I'm in a balanced fund, I can't choose that. I mean, it's all together. If I sell shares of it, it's going to, if it's a 60-40 fund, 60% is going to come out of stocks and 40% out of fixed income. I can't control that. My answer to that is, well, if the market is down, really what you want to do is buy stocks as part of rebalancing. And guess what? That fund does that for you. So, if the market's down 20% and you pull money out, you're actually still going to be, assuming you pull out whatever, 2, 3, 4%, to live on for the year, you're still going to be a net buyer of stocks because the fund is going to be rebalancing, which is going to mean it's going to be selling fixed income to buy bonds or to buy stocks. And by the way, even if that didn't give you enough comfort, we're in a retirement account, let's assume. I mean, you could always keep it in the retirement account, but sell more than you need, take out only what you need, and the extra, put it back into a stock index fund, I guess, if that's what you wanted to do. But again, because the fund is rebalancing, the rebalancing takes care of the concern about selling stocks when they're down. I suppose the only exception to that is, if they're only down 1 or 2%, you could still end up being a net seller of stocks if you're taking out more than that, depending on the exact numbers. But that's going to be just a tiny bit. I mean, because the stocks were only down 1 or 2%. But most people, that's not what they're worried about. They're worried about a 10 or 15 or 20% drop or even more. And in that situation, whether you're rebalancing on your own or you're using a fund to do it, the rebalancing is going to end up causing you to buy more stocks, right? So in any event, I think a balanced fund is a perfectly reasonable approach. I just personally wouldn't do it in a taxable account. Oh, I forgot about the poll. Hang on, I've got a spam call. I get more. I'm so popular. Every time my phone rings, and I see it on my watch now, it says potential spam. How'd you guys vote? Let's see. So 1% have never invested, 11% are beginners, 58% are intermediate, and 31 lots of experience. Okay, I guess that seems right to me. The reason that question came up was I got a great email from someone who, here was their question. They said, I have a 401k at Fidelity, but I want to have a cash management account there, and I don't know how to do it. And I think in their mind, they were thinking, is this going to be part of the 401k? How does that work? And so I emailed her back and I said, you just open up a new account. You can just open up a cash management. It's a separate account from a 401k. It would be separate if you also had an IRA there. It would be a separate account if you had sort of just a regular brokerage account there. And it struck me that, when I was starting out, I had all the similar types of questions of just things that because you don't know what you don't know. It's like, you open up, you contribute money to a 401k at work, let's say. And it may not occur to you that you then need to actually log in and invest it or set it up so that it gets invested in a certain way. Same is true with an IRA. If you open up an IRA wherever, Vanguard, let's say, and you just put money in it, it's going to be in whatever cash account. It's not actually invested in anything yet. An IRA is not an investment itself. It's just a type of account. So someone asked me a similar question is a cash management account risky? And I had to explain, well, it depends what you invested in. You can invest your money inside a Fidelity cash management account in basically anything. It's a brokerage account. I could put it in a Bitcoin ETF if I wanted to, and it would be very risky. That's not how most people use the cash management account, I don't think. And these questions, they're all good questions. They just are. I mean, when you're starting out, these are the kind of questions I had. I mean, we didn't have fancy things back then, like cash management accounts. But I went to a bank. I remember I went to, I forget the name of it. It's since been acquired, but I didn't know what I was doing. And I was looking at investing in a mutual fund. So first of all, don't ever go to a bank to invest anything. That's the first mistake I made. And they, of course, wanted to put me in A shares, 5.75% sales charge. That's what they do. And I didn't know, I guess that's just normal. That's just what people do. And so, these sorts of, I guess I'll call them beginner questions, are really important. And you should never feel bad that you're asking them. Keep asking questions until you're comfortable, and don't stop asking questions. I keep asking questions. Some are intelligent, others not so much, but So Julie says, my pension from Ascension is managed by the church. I'm not sure what that means. It has no government insurance, investments not viewable, prior lawsuit, 97% funded, take lump sum. Well, I don't know a thing about Ascension, what it means to be managed by the church. And there are probably other things to consider between taking a pension lump sum or not. But boy, I think if I were in your shoes, I probably would take the lump sum. All of that kind of scares me. Brian says, what is your take on William Bernstein's philosophy of if you've won the game, stop playing? Well, I guess we'll ask him when he's on the show, right? I think there's some truth to it. I guess I'd put it this way. My ultimate goal financially is not to die with the most amount of money. That's my second goal. I'm just kidding. It's to meet real world goals, having money to live on, taking care of the family, keeping the lights on. And so I always ask if I met that goal or not. And if I have, I agree with Bill. I don't want to do anything that's going to jeopardize those outcomes. But you have to be a little careful, in my view, because it's certainly true that in one sense, stocks are riskier than bonds, which are riskier than cash. They're riskier in the sense that they're more volatile. But in another way, cash is much riskier than stocks, right? If you said, I want to beat inflation over the next 30 years, how risky is cash? I'd say pretty darn risky. There's a lot of risk. If you said, I don't want to lose any money and I don't care about inflation, I don't want my dollars, the number of dollars I have to go down, then cash is pretty safe. So it depends what risk you're most concerned with. But to me, I don't really see having some exposure to stocks as playing the game. As long as it's a well-diversified portfolio, and there's so many other factors in terms of your financial stability and resilience. Do you have debt? What's your ability to earn income, even in retirement, right? If you want to do that. So, but I certainly agree with Bill that I do not want to take unnecessary risk. I think the difference for me is I've never wanted to take unnecessary risk. It wasn't as if, for me, I got to some points, okay, man, I was really taking all this crazy risk, and now I've arrived, so I'm going to cut back on that. I mean, it is true that my portfolio allocation has changed, but I don't. And maybe that's what he's talking about. And I know the reference you're making. Maybe that's what he means. Why have a 90-10 portfolio? You can cut back the volatility with a 70-30 or 60-40. I do think at times, though, I think he's talked about tips, ladders, and other things, which I think are useful tools in retirement. So I think he and I probably more or less agree on that, but we'll ask him when he's on the show to make sure we've got the fine point there, what he's getting at. And the best way, by the way, I don't know how much he'll disclose, but it'll be to say, okay, Bill, what's your portfolio look like? That tells you more than anything, right? Jonathan says, nowadays you couldn't touch the apartment on Beacon Street. Rent would be $8,000. So this was a building then was owned by Boston University, where I went to law school. And our rent was $600. This was in 1989. And we couldn't afford a parking spot because that was $75. We could afford it the third year of law school, but not the first two. So I would often drive around literally 30, 45 minutes looking for a parking spot. I got tons of parking tickets over the 3 years there. And at one point, our car got stolen. So yeah, we were kind of ready to go. All right. Dave says the thing about being an experienced investor is that you've ridden the roller coaster of the markets. That's certainly true. you will get a lot of experience. Well, not just living through a bad market, but also living through a bad market when you've got some money at stake. So when I lived through the tech bubble, it hurt, but I'd only been out of law school and investing by then, maybe 8 years. So, we had some money invested in the 401k, but it hurt more in for the financial crisis. It definitely hurt a lot more with the COVID drop. And there you're thinking, I don't know how bad this is going to get. Of course, it turned around very quickly. You find that your risk tolerance does change over time. In some ways, you feel that you're able to take or live with the risk that you have well. But in other ways, you think, yeah, it's time to cut back. Fishy says, your survey neglects to the insight of how successful have you been investing. That's an interesting comment. How would you even measure success? I mean, one approach is to say, well, everyone wants to compare their portfolio to the S&P 500. I think I've been a very successful investor. And the reason I think I have is for one thing. And by the way, if I go back to when I started investing, I have no idea how my returns compare to the S&P 500. So it's got nothing to do with that. And as you know, I'm predominantly in index funds anyway. So, but it's been my willingness to stomach bad markets. I've never sold in a bad market. Who knows about maybe the next one I'll cave. I don't know. But I've never gone in and sold stocks. The tech bubble, the financial crisis, 07, 8, 9, COVID. And it's really, I'm going to look at this comment here. It's really where most of our gains have occurred is by sticking to our plan during those times. That's where the money's made, or in our case, not lost. Maybe that's a better way to put it. The 4-number results in portfolio visualizer. I don't know what that is. See if we can figure it out. I'm not sure. Portfolio visualizer. The 4 numbers. Can someone help me with that? I don't know what that means. Not sure. All right. I'll come back to that if I figure out what that is. Well, I think that's a typo on Doug's last name, but he was at Boston College, as I recall. So Boston College and Boston University are 2 very different institutions. By the way, as far as I know, they're both good, but BU is in downtown. I mean, it's gritty. We're right in the, Kenmore Square. Boston College, I mean, they were out in the burbs. They were high class out there. But I can tell you how good Boston University's football team is. The whole program shut down when I was at law school. But they do have a pretty good hockey team, at least some years, I'm told. I never went to a hockey game. I don't even know what's wrong with me. I went to one Celtics game. I got to see Larry Bird play, and of course, he's great on TV, but to watch him in person, and it's just phenomenal. His ability to pass the basketball, even what seemed like it's a normal kind of pass. It just watching him on the court was ridiculous. Kevin McHale was there. He was playing still, and at halftime he came out and he was warming up, and he was like, shooting 18-foot jumpers, and he must have made 40 in a row. He never missed. Of course, he didn't have anyone guarding him, but still. We sat right behind a post, so we had to, do one of these to watch the game. That was the old garden. All right. At one time, someone was buzzing the door, to get in, and I was actually heading out. I think to go to the store. Nighttime, 9 o'clock at night, and it was 2 rough-looking guys, and they had guns. And I'm thinking, yeah, I'm not opening the door. So then he flashes a badge at me. I'm like, yeah, I don't know if you're a cop or not, but this is not how cops should normally behave. So I turned around and went out the back door. We were ready to leave Boston. I actually went to the police station to report it, and the guy that took the report was clearly not going to help me, and so he gave me a stack of police officer photos about this big that looked like it was 38 years old, and said, "Okay, identify who it is." I said, "Well, I don't need that. I've got his badge number. I remembered it when he flashed it at me." "Oh, we can't use the badge number. That's a violation of due process." And I'm thinking, do people actually buy that when you tell them that? I didn't tell him I was a law student because that kind of seemed lame. Although I did get an A in constitutional law. All right. So Jan, is it Jan or John? John, could you comment on, do the majority of retirees limit their spending to Social Security and income from interest and dividends? I thought your newsletter had a reference that said that. There could have been an article about that. I don't specifically remember. I mean, I don't have data on this. I think, though, I think the data that I've read shows that a lot of people live primarily on Social Security, and the withdrawal strategy that I would suspect is the most common is one that spends Social Security and RMDs for folks that have some savings, required minimum distributions, and they just get their RMD from their accounts every year. They spend that, and they spend their Social Security. And if they have a pension, they spend that. If they have taxable accounts, and maybe this is what you're thinking of, I did link to a study, and I think David Blanchett was the author. So he's done a lot of great analysis. I should have him on the show. I've never met him. I have to reach out to him, but he's written a lot of papers. He's the one that came up with the retirement spending smile, which was in the 5-Question Friday last week. Where he's done some studies that show people tend to underspend, and they tend to just want to spend income. Again, psychologically, this goes back to Jonathan's point. I think this is a very real sort of approach, is to say, I feel comfortable spending the interest and dividends. I want to keep my principal there. I don't want to touch it. And if you're happy and comfortable, it's a perfectly reasonable way to go. You will underspend that way. By underspend, all I mean is you'll spend less than you probably could have spent, but that's okay. I plan to underspend. So that's, I don't say that as a criticism of that approach at all. So yeah, John, I think it's a reference to, I can maybe even find it. Maybe. Let's see. Oops. So I've started linking to the newsletter to this page, which is all my past newsletters, or at least all of the ones since I moved my newsletter over to this company, Kit. And I think wasn't it last week that I linked to his article? Maybe not. I'll look at one more. Maybe it was 2 weeks ago. I don't think it was last week. I don't see it. But yeah, he's written papers that basically say a lot of folks just spend their income. Yeah. What do we got next? VWIAX for retirement in my traditional IRA. So Vanguard, that's the international fund, right? VWIAX, Admiral shares, maybe. Oh, this always throws me off. It's Wellesley. Here it is. So this is this comes up every now and again. on the live show. So this is an actively managed fund, but unlike most actively managed funds, it's very inexpensive. Now it's a tad more than some index funds maybe, but 16 basis points is really inexpensive. And if we go to the portfolio composition, we can see that it's 40% stocks, or almost 40%, and roughly 60% bonds and short-term reserves. This fund is one of the oldest mutual funds. Wellington is another one from Vanguard with a different asset allocation that's also done quite well. These have done extremely well. And I think this would be a perfectly reasonable fund inside an IRA. I prefer index funds, but this is done very, very well. If you wanted to compare this, we could actually compare this. Let's try this. So it's roughly 60-40, right? Roughly 60%. Let me go back. It's 40% stocks, right? Yeah. So VWIAX. So what we can do is we can pull it up in Morningstar. We can look at the performance first, and if we go to distributions, you wouldn't want this in a taxable account. I wouldn't, because of the long-term gains, the short-term, which are the dark blue, short-term gains, light blue, all the income. But in any event, we can go to chart, and you always want to make sure you got the right data type. I always do growth with dividends, but I don't know if that's the best, but we can look at Max. It's been around forever, but Morningstar goes back to 1970. Wow. That was a great decade for the Cincinnati Reds and the Pittsburgh Steelers. All right, let me pull up a fund. What can we compare this to? I think we can compare it. Let me pull this up and I'll show it to you. A Vanguard Life Strategy Fund. Don't they have a 40/60, right? Let's see. Yeah. So it's not a perfect match, but it's close. 40% stocks, 60% bonds. It's VSCGX. And inside this fund, we can actually pull it up. This fund is comprised of index funds. In fact, you can see them down here. Here we go. These 4 funds: U.S. stocks, international stocks, U.S. bonds, international bonds. So that's it. And so we can take this, come over here, compare it. Now this fund hasn't been around as long. So when we compare it, it stops here. Well, that's not any good. So we can go to display. A viewer emailed me this trick, and you can pick the start date common, and it brings us it shortens, in this case, the VWIAX to when the index fund started. And look at this. It's crushed that index fund. Crushed it. I did not expect that. I did not expect that. Now, one thing to note is that with VWIAX, I'm guessing its stock bond allocation changes over time, but probably I wouldn't think it changes a lot. But I don't know historically how much variance there is in its stock bond allocation. Yeah, it's done really well. Now, what the future holds, I don't know. I don't know what's going to happen tomorrow. Yeah. So you mentioned covered call ETF nonsense. Yeah, I should probably be a little more careful with my views. Although I do think I just think they're, and buffered ETFs, I just don't find them. I find them. It's like if we took a really simple way to do things and said, okay, now let's make it really complicated and expensive. Anyway, do you feel that way because the returns are done at the expense of inherited capital decline? So I just generally, so the way a covered call ETF, so if the market is doing well, a covered call ETF fund will underperform a comparable index. So if you have a covered call ETF that's writing calls on the S&P 500 and the market's going up, it's going to underperform, right? There's more expenses and shares are getting called away as the market goes up. The option strategy doesn't pay off. If the market's falling, it'll do a little bit better because of the premiums it earns on the options. And so I suppose one could say it gives me a little bit of downside protection. It doesn't, by the way, it's not like a buffered ETF where you literally get some downside protection. Because the underlying index is going to fall, the covered call ETF is going to fall too. It's just that it's also earning those premiums from the options, the covered call, the calls that it's selling, and that will offset some of the losses. Hope that makes sense. But it seems to me like a silly way to do that. If you want a little bit of downside protection, then just change your stock bond allocation. I feel the same way about buffered ETFs. But I'm sure maybe I'm missing something. I don't know. I just don't see the point. This is a good point. Braxel says, I wonder, do people sometimes realize that they do not need to add a portion of their income in retirement for saving money for retirement? Yeah, I think probably they do. Yeah, once you retire, the expense of saving for retirement goes away. That's one of the reasons when you hear rules of thumb, what percentage of your income during your working years do you need to replace? It's never 100%, right? 70% I hear. But and there's other reasons for it beyond just that. But yeah, it is one expense you no longer have, for sure. I must have missed some fitness discussions. A good PT would show you how to strengthen your knees. You guys watch the knees over toes guy? He's pretty good, like on YouTube or TikTok. I don't know if he's on TikTok. I've started doing. I'll show you what I started doing. Let's see here.
Welcome into.
I started doing rope flow. Have you guys seen this?
Fitness. I'm Coach Kel.
Let's see. I don't know this person, but you do all these movements with a rope, and it's really good for your shoulders and your hips. It gets a lot better than that. He's just warming up. Let's see what we get. There you go. That right there, once you know how to do it, it's easy. But until you know, I don't know. It's tough. Oh, the Matador. I know that one. I've started doing that. I actually linked to a interview that Tim Ferriss did, which is where I learned about rope flow. It's fun. I just do it here in the basement. Like, I'll stand up from my desk from working and do rope flow for 5 minutes. Don't know that it helps with the knee, though. I'm not sure. Don says, first time watching live, hard to follow the chat and pay attention to Rob. I can never do a show like this. Yeah. It is. I will say, when I get done after an hour and a half, I'm pretty tired. It reminds me in the days practicing law, I've taken a deposition all day. And you're just sitting there, I'm asking questions. You've got a pile of documents. Isn't it true? No, you don't act that way in a deposition. Well, I didn't. You show him a document. I used to work with a lawyer. He would show you a document. He would say, now, this document, it's dated January 3rd, 1997. Wouldn't you agree? Yes, I would. Anyway, my point, I don't know why I went off on that tangent, but after a day, it's exhausting. It's like you've run a marathon. I would come home and crash, and then you'd get up and do it the next day. Anyway. This is kind of like that. Your vision is amazing for your age. So the thing that helps me is that I have one eye that's really good at distance and one eye that's really good at reading. So they kind of, make up for each other's deficits. Wow, Keith had 2,400. before LASIK. So Jonathan mentioned cataracts. Are cataracts like my mom has cataracts, her mom had cataracts? Does that mean they're coming for me, or does pretty much everyone get them if you live long enough? I don't know. I don't know how that works. How are we doing on time? It was 8:26. We only got 4 more minutes. I'm still at the chat at 7:57, so I'm like a half hour behind. We're watching Blind Spot, which I guess was like 2015 to 2020. Blind Spot, right? Yeah. And this is a spoiler, not that it's so old that maybe it doesn't matter, but Bill Nye the Science Guy does a cameo. He's in it like for 1 or 2 episodes. You guys know what I'm talking about? It was a riot. So Patterson is one character. So all these FBI shows, they've got the one person who's like smarter than everyone else, computer hacker. They have these scenes where like, well, boy, if we only had all of the calls that they made from their iPhone, I can get that for you. And they, here it is, very realistic. That's Patterson. And it turns out Bill Nye, the Science Guy, played himself, and he was her dad, which was perfect. Really funny. All right. Oh, wait a minute. We got someone retiring on Friday. Joe, I retired this Friday. It's amazing. Should I change my retirement account from limited choices through EIRA is through Empower or Fidelity or Schwab? My IRA is with Vanguard. I don't know. I guess my question to you would be, are your limited choices good? Are they good choices? There could be other factors to think about. But like, same like with the thrift savings plan with the government, you don't have a lot of choices, but they're all really good choices. But congrats on the retirement. All right. This is a deep question to get into with just 3 minutes left. But opinion on taking Social Security to 62 versus 70. One certified financial professional I watched on YouTube advocates, should you really get advice from YouTube? Anyway, advocates taking it early because of the time value of money. Money is worth more now in the future. Is that valid? No, it's not really valid. I mean, it's a factor. It's a factor, but so is the increase in benefits that you're going to get if you wait. I think the bigger issue is what role will the Social Security benefits play in your retirement? So for example, for some people, they'll say, look, I can afford to wait. And by waiting until, let's just say 70, you don't have to wait till 70, right? 62 and 70 aren't your only 2 choices. But by waiting till 70, I'll get the largest benefit possible. And I want that either for 2 possible reasons. Just longevity insurance. If I happen to live to be 103, I'll have the largest Social Security benefit for all that time. And 2, and this is important to me, if I go first, my wife would get my higher benefit because my benefit will be higher than hers. And I want to be able to leave her with as much money as possible from Social Security. So whereas she will no doubt start claiming Social Security earlier than that, haven't exactly decided when, but definitely earlier than 70. I will wait. And that's a big reason. A tool that I like a lot is Open Social Security. Mike Piper developed it. If you search the channel, I interviewed Mike. I've known Mike we don't talk a lot. I think he lives in Colorado maybe, but I've known him for maybe 15 years. But in any event, this is his tool, and it's very easy to use. And, so you might play with this to get an idea. Oops, let me remove the comment. One thing I'll mention about this tool is if this little checkbox here, it seems so unimportant, but if you click it, it opens up a bunch of options. Possible future cut in Social Security benefits, you can check that and run some analysis. If you have children under the age of 19 or permanently disabled, so a lot of different things you can do, but this is a good tool to try. But the idea of, well, I should just take it 62 because of the time value of money, I think doesn't really begin to answer the question how you should and when you should claim Social Security. I mean, again, it's a factor, and in fact, if we go to back here, he factors it in using the discount rate, which is right here. So his default is 2.4%, but if you check this, it opens up this input, and you can change it if you want. He explains here why he uses what he does. And he has an article here that you can look at for more details. So, this is an important factor, but it's just one factor. So, at least in my view. Well, it's 8:31. So I guess that's the end of the show. It seemed to go by fast. Philip asked if I want to have a pro. That's not it. Where'd he go? Here we go. A pro tax advisor on the show. I think that'd be great. Actually, frankly, Andy can answer a lot of those tax questions too. So, yeah. So, but I can look into that. I'd like to have a trust and estates lawyer on the show, just so we know. So, in terms of the next live show, so part of the issue is life is crazy for me over the next month. So the next live show is not for 4 weeks, the 18th of August. So I can't do the next 3 Mondays. Well, normally it wouldn't be next Monday, but the Monday after that, can't do it. So the next live show will be August 18th. I might get Andy or Bill on the show for that date, but if I do, I'll let you know in the newsletter. So if you haven't subscribed to the newsletter, it goes out every Sunday morning. It's free. You can subscribe below the link below the video. But the next, it looks like I have a dentist appointment on that day. Hope I can talk. Do I have a dentist appointment already? Anyway, yeah. So the next show will be August 18th. I do plan a number of videos that I want to put out between now and then. A lot of them based on questions you guys have sent me, which are just excellent and gets me to dive into different things. So I'm working on that. And yeah, so that's it. Hope you enjoyed the show. Hope you have a great week. Congrats to those retiring either this Friday or in 41 days. That's awesome. Hope you have a great retirement party. And until next time, remember, the best thing money can buy is financial freedom.